Good afternoon. Thank you for joining us today for Surge Energy's year-end webinar. Surge trades under the ticker symbol SGY on the TSX and ZTPAF on the OTC. With us today from the company are President and CEO Paul Colborne and CFO Jared Ducs. Congratulations on a fantastic year, guys, and couldn't have asked for a better, to be honest with you. And I will turn it over to you to present the highlights of Q4 and the year, and then we'll do a Q&A section. Please enter your questions in the Q&A box and or email me at jessica@adcap.ca. And over to you guys. I mean, again, congratulations. It was better than I even thought it was going to be. So.
Thanks very much for the intro, Jess. And I've got Jared with me here. It's Paul. We're thrilled about the quarter, but our Q1's even going to be better, and we're excited to show you how the asset quality, I always talk about it, but how it generates top financial results. So that's kind of the theme here. We just put out our quarter last night, wild beat on both production and cash flow, sold our non-core assets, and we were planning now with the asset disposition of about 1,400 BOE. We said we're going to average 22,500 BOE, and we're in two of the best plays in all of North America. Paid our debt down, did a debt deal that companies our size should not be able to do. We went out and got a B+ rating on the bond and did a $175 million note deal, locked in 5-year money, and it's created a $250 million undrawn bank line today that Surge has. And we now have cash on the balance sheet. Great dividend. People ask me, is your dividend safe? Well, with a 9% yield, with one of the lowest payout ratios in Canada, we have the third lowest payout ratio. Our dividend is only 17% of our cash flow on the quarter. Extremely low. Some of our peers, CNRL's 28%, Headwaters 26-28% payout ratio on their cash flow. Surge payout ratio on our dividend is only 17%. We're in buying our stock back, started our share buyback program. Been buying our stock back aggressively. We're trading at PDP value. PDP means proved, developed, producing. Blow the company down, sell it, never drill another well. That's what we're trading at. So very attractive metrics. The big thing Jared's going to walk you through is our discovery at Hope Valley. It's 32 sections. It's 18 miles long. Get in your car and drive 18 miles. We drilled 11 screamer wells in a row, and we have 100 to drill there. Had a really good Sproule Report. You'll see that the value of our company, total proved and probable, is $14.39, and we're trading just over $5. The PDP blowdown value is $5.42, pretty much where we're trading. Total proved case, which is drill about 300 of our 950 locations, about a third, is $9.33. That's from Sproule as of this morning.
Were there 300 locations, you said, Paul?
Yep, exactly.
Okay.
Jared's going to walk you through quickly what I just said there.
Yeah, definitely. Thanks, Paul. Yeah, I think it's really important to note here. So on the Sproule deck, if I look at that middle column in the bottom table, that's our proved reserve value there. So that, as you can see in the top table, only reflects 284 net locations of the over 900 locations we see in our company. So less than a third gets you the total proved case of 933, and we only have 367 net book locations in our proved plus probable, or 2P net asset value that Paul referenced, of $14.39 a share. So only a fraction of our inventory is inside of these numbers. So it really shows the power and more importantly, the economics of our asset base. From a reserve replacement perspective, really solid reserve year with a 94% PDP organic replacement ratio. And I think more importantly, after those two core asset or non-core asset sales that we completed in 2024, nearly all of our company's reserve value, pushing 95% of that NAV, is in the Sparky in Southeast Saskatchewan, which we'll talk about in a minute. And for those assets, we had about 113% organic PDP replacement ratio. So really strong reserves, a great net asset value here that reflects only a fraction of our locations. So really excited about the power of our asset base shining through our Sproule NAV.
And how many locations do you think you have internally?
950 locations in inventory, yeah.
Yeah.
And this is the key to Jess's question. Those 930 locations, we drill about 65 a year. That's how we get to about a 12-year inventory of drilling. This is the key. They're on two of the best 3 plays in all of North America as independently ranked. So this slide I showed, just sometimes it can get, oh, how do I make all this work as an investor? You go, well, everyone says they're good. High quality, low risk, conventional assets with high netbacks drive top financial results. And that means free cash flow.
Yeah, so our guidance is looking really good for 2025 here, about 85 million of free cash flow before dividends. This is run at 70 WTI, but we'll perhaps talk about it a little later here. But we put on, as you saw in the Q4 release, meaningful swap positions upwards of near $76 US a barrel here, for instance, here on 7,000 barrels of our production for February and March, for example, and lots of good hedges out through Q3. So we're really able to buttress a lot of the this near-term drop we've seen in crude, so that our cash flows today are at 66, 67, where oil's trading today, very similar to these levels here. So we have $85 million of free cash flow, giving about 50 million of that back to our shareholders through the dividend. The rest is going back through buybacks as well as some debt repayment. So great free cash flow margins even today, thanks to our asset base and our hedging program. A few other notes that I'd say here is this is based on a $170 million capital program. Because of the success we've had at Hope Valley and in our Frobisher particularly, we were able to take our capital back substantially for 2025 and deliver the same sorts of production levels. You know, we budgeted 195 million, or spent rather $195 million last year on total capital. We've dropped that $25 million to $170 million for 2025 on effectively the same production levels after the non-core dispositions. That's $25 million of free cash right into our shareholders' jeans effectively. The other thing I'd note here that's a differentiator versus some of our peers, many are paying between $4 and $6 a barrel of cash tax. Surge is in a very enviable position of having $1.3 billion of tax pools. What that means is we can shelter our income and our free cash and deliver that to our shareholders tax effectively for 4+ years at current pricing. So delivering significant margin, 31% free cash flow to our shareholders tax efficiently here in 2025 and beyond.
Yeah, just one question I wanted you to highlight. In case for those who did not read the release, just that your hedges on the we're mentioning.
Sorry, Jess, you broke up for a moment there.
Oh, sorry. Just for those who didn't read the release, I think the hedges on the diffs are worth mentioning as well.
That's a great point. Obviously, with all the tariff noise, we have seen just a slight widening in the Canadian oil differentials, the WCS differential and the light differential, which is called MSW. Surge has got 60%, for example, of our WCS differential exposure hedged for the balance of the year at very attractive rates under $14 discounts. So, you know, we've really insulated Surge from the bulk of any tariff noise here for the rest of this year. So we're in really good shape there on the differentials as well. Good point. Return of capital, I touched on this. Obviously, we're returning $85 million to shareholders, the dividends in there, and then the rest of the free cash is going substantially to buybacks as well as some continued debt reduction. So in a great position here to hand it all back to shareholders through dividends, buybacks, and increases in net asset value through reducing debt.
So while we have low debt, we could increase the dividend. I'm looking at it here it just strikes me about 60% out of free cash flow at $70 oil with our hedges on. We already have a 9% yield. So we said, no, don't do that. Let's go buy our shares back because we're trading at PDP value to blow down the company value. So we're aggressively buying around 3% of the company's shares back this year could even ramp it up further. So we could make it base dividend. So we're giving you the money, 53 million through the dividend and 32 million through the share buyback.
Good point,
There's
Paul.
actually a typo there.
Yeah, so this slide is good. Oh, this slide is good. We didn't write this up. Eric Nuttall wrote this up. 9 Point Partners. Surge has the third best free cash flow yield in the country. We agree with this. But look at what I said to you, the sanctity and the safety of the dividend. A lot of people on this call, they want exposure to the top plays, a good team, low debt, but they want to know, they want the dividend, but they want to know it's safe. So there's Surge's payout ratio versus other companies in our peer group, one of the lowest in all of Canada. I won't dwell too much in this. We're at world record oil demand and the lowest inventory levels worldwide in, or is that US? I think it's worldwide, global inventory levels since they started collecting data in 2017. This is my favorite slide. If Jess puts $100 into the common equity S&P in 1973, her investment today is worth $843. Very nice, but not great. If you put it into an increasing compounding dividend model like Surge and compound the dividend, her $100 is worth $14,000 today. That is Surge. We bumped the dividend in 2023 by 14%. We bumped it last year by 8%. And we're already talking about when can we bump it this year. But with our yield at 9%, our thought is we'll keep buying stock back. But you saw it today. We're outperforming the market dramatically with our quarter. So we'll see how the stock price goes. This is the key for us. I mentioned high quality assets deliver top financial results. No amount of Paul talking, Jess talking, Jared talking, anybody changes this. Deep, expensive, tight rock along the bottom is what we call permeability. So it's the holes in the rock, the perm of the rock. So tight rock that's basically tombstone. Over on the left, Duvernay, Permian, Montney. Very tight, high cost, deep, expensive rocks with huge fracks, huge declines. Wildly outperforms low risk, shallow, conventional reservoirs, perms of 100 millidarcy range, which is what Surge is. Low cost, low declines, water floods, and you get your money back 3, 5, 7 times on your water flood on your investment. That's it. And it leads above the line. You see PIR means profit to investment ratio. You get your money back 3, 4, 5 times on a Surge play, and you get the highest rates of return in the industry. This is just a sum up of that, but Jared's going to show you along the bottom column what it means to a shareholder empirically on this slide.
Thanks, Paul. Yes. So, big outcome or output, of investing in these large oil in place conventional reservoirs is getting a large amount of original oil in place. So that's just volumetrics, big tanks of oil under the ground, if you will. I would note here, we've added nearly 400 million barrels to this number year over year. That's with the expansion of the Hope Valley play, notably, and land acquisitions and growth in our Frobisher play in southeast Saskatchewan. So as Paul always says, big pools get bigger, and we're seeing that in the numbers here. So as a consequence here, you can see we've only cummed or produced 6.7% along that bottom row of the 2.7 billion. And the great thing about conventional reservoirs is they don't stop at 6, 7, 8% like very tight unconventional reservoirs. They're amenable to things like water flood. That allows us to take recovery factors to say 10, 15% on primary. And we have pools that are upwards of 35% recovery factors under flood. So that's the gift that keeps on giving when you buy these conventional large oil in place pools. To give you a sense of impact here, if we get a 1% change in that 2.7 billion barrels we have and take our recovery factor from 9.4% as currently booked to just 10.4%. 1% of 2.7 billion, 27 million more barrels out of the ground for Surge and its shareholders. If you put a $40 net back on that, that's in excess of $1 billion of future undiscounted cash flow to Surge. For context, that's well beyond our enterprise value today in added value for just a 1% change in that recovery factor. So, incredible power for getting small changes in recovery factors, and that's why we like these types of reservoirs.
And you have a lot of your assets under water flood now and have been for many years. When do you think you get an increase in your recovery factor from Sproule?
We get it every year, and we are looking at a 54% reserves replacement number initially, and then the new Hope Valley discovery, and then water flood and whatever. And now we're at 113% reserve replacement value for our Sparky and Southeast Saskatchewan assets. So it just shows you how powerful water flood is when Sproule gives you credit for it. So 100% of our assets, 55% of our total production are under pressure support, and we're actively converting good wells into injector during every year to get that recovery factor up.
Yeah, and another just quick good point here is, to that 9.4% booked recovery factor, that's only the 367 booked locations that we talked about that get us there. We've got upwards of over 900. So as we drill those, as we water flood them, just naturally over time, that recovery factor will get more and more of those barrels over time.
I realize it takes a while for them to catch up, but yeah.
So for investors, this slide is key. And it goes back to that slide I mentioned real early about quality of asset driving top financial results. I didn't make this study up. One of the top firms in Canada, boutique oil firms, Peters & Co. did. Last year, Raymond James, the year before, National Bank. Smart investors said, don't just give it to me on the payout of the well. Tell me when I get my money back, 100% of my money back, and 100% profit. So 92% of Surge's company is now in 3 of the top 4 plays in all of North America for giving you your money back and 100% profit, as independently ranked by Peters & Co. And it's thrilling for us when you add our Sparky core area and our Southeast Saskatchewan core areas. You're at 92, 93% of our company, and 100% of our capital is going into these top plays. Jared's going to talk to you about Sparky. This is one of the hottest plays in all of probably North America, but Canada for sure, is the Mannville Stack. And the Sparky Formation is one of the horizons with the Clearwater in the Mannville Stack. And we're the big player in Canada in the medium and light window of the Sparky.
Yeah, thanks, Paul. Just a quick refresher. We've shown this slide before, but the Sparky's been around for over 100 years. There's over 11 billion barrels of original oil in place throughout this fairway. As Paul alluded to, Surge is one of the dominant players in this, particularly in the light and medium window. So as you push north past Lloydminster, which is starred at the top of the map there, it gets into the real heavy, the oil sands. But this area in the map that we're showing where Surge has a dominant position, there's about 4 billion of the 11 billion in that light and medium fairway. We control over 1 billion barrels of that. So this has been a fabulous play for us over the last decade. We've drilled over 250 multi-frac horizontal wells. But importantly here, and what we'll chat about, is really the advent of the multilateral drilling, where you're coming in drilling 8 to 12 legs sideways beside each other, has really opened up the fairway. And that's really that shaded section you see where Hope Valley sits. That's where we've had some really exciting developments we'll talk to you about. We've now drilled in our history here since 2020, 26 multilateral horizontal wells. The Sparky is just continuing to perform for us. We started the company recapitalizing it, having effectively no Sparky production. We've grown it well over 12,000 barrels a day today. Fabulous asset for us, closing in on nearly 1.5 billion barrels of original oil in place here now. And we'll drill about 34 wells into the Sparky here. From a capital perspective, about half of them will be the single lat fracked wells in the lighter window. The other half will be these exciting multilateral wells into the slightly heavier window, predominantly at Hope Valley. So I'll touch on Hope Valley here. This is an organic discovery, the biggest crude oil discovery organic in Surge's history. Nearly 200 million barrels of original oil in place on this land map alone. We put together 32 sections here. We've now shot 3 separate 3D seismics that you see outlined in blue on the map, and have really been excited about not only the original wells, but the repeatability and how similar these wells look. You can see on the graph in the bottom left, the original 12-leg well that we put into the left half of the pool there that's being called out. It's been on for over a year here. It's leveling out at over 100 barrels a day over a year later. We had anticipated that being something like 60 barrels a day. So you can see the black line here is the average of the wells. It's about 20-25% above our type curve estimations. So this asset has been fabulous for us. We now expect to drill about 12 wells here this year. We're going to have a rig here drilling pretty much nonstop. Excitingly, for the first time, we're going to drill a 4-well pad here that's just starting here to the west of the green battery that you see on the map, doing a 4-well pad through breakup. These wells are taking now only about 18, 19 days to drill. So we've seen the drilling time come down. We've seen cost efficiencies on a pad drilling basis. So these wells are fabulous. They pay out in just over half a year, and they have 60, 80 barrels a day on type curve is what we expected to pay out. They're doing over 100. So fabulous asset for us here. It's doing about 3,300 barrels a day today. We anticipate it growing substantially from there towards year end. So it's outperforming our expectations, and it's really what's leading to those production beats in concert with the Frobisher assets we talk about here in a minute.
I have a couple questions on Hope Valley. Should I ask them now? Is that...
Go for it, yeah.
Okay. In your reserve report, were they using the old type curve or the new, or what the wells are coming in at right now?
Yeah, they're using this type curve that you see on our presentation here. And the wells, like Jared said, we're already at 3,500 barrels a day, and we have about 8 or 9 more Hope Valley wells to drill this year. So we're going to beat the 3,500 barrels. It's probably cash flowing $45-50 million for Surge already at this size. So we only booked in our new engineering 18 Hope Valley locations out of a total of probably 100 that we think we have to drill on our 3D seismic.
Okay, and do you think you've delineated the field pretty much with the seismic you've done?
Yeah, and the step-out wells to the north there, we call it Hope Valley Gilt Edge, but we've had 2 screamers up there, validates the huge step-out almost 7-8 miles to the north. We've got a 3D down south. There is a solid oil well down there. So we think the whole thing is one monster pool, 250 million barrel pool, and we dominate it. We've got 32 sections. We're working with a couple bigger companies to take out the rest if we could get a deal like that. So it's pretty much a company maker asset. We think we can get it to 8,000 barrels a day plus over the next 3-4 years.
And then you would just keep it flat. So this is a true resource play, really. Is that fair to say?
It's a conventional resource play, and Peters wrote this morning, I think it has probably around $4 of value while we're only trading at $5.
Yeah, that's what they said. Yeah, $4 of value.
Yeah.
With that. And just oil in place per section is how much?
It's probably 8 to 12 million barrels. We just left the lower number in there, but if you do the math, it's about 4.5 meters. There's a little break and another 2.5, 3 meters. So it's about 7 meters of pay, and you're looking at 2.3 million barrels in place per section per meter. So, well over 10 million barrels, 10, 12 million barrels in place per section. And it's got clean API and really good viscosity. So it's not goo. It's not heavy oil. It's excellent medium gravity crude, high netback.
Yeah, we built a battery there in late Q4, highlighted in green. So everything's centralized. We've got the gas handling in here. So we really are seeing true half cycle economics moving forward out of this play, which is really exciting for us.
Okay.
So the second asset, it's the third best play in North America, is our Southeast Saskatchewan asset. 3 years ago, we were 0. Now we've hit 9,000 a few months.
I was just going to say, yeah, there was you had 0 production there. So
yeah, so it's been good. We've done a couple acquisitions, and now we're on a great drilling run there. Light oil, downstream of the apportionment, beautiful high netback light oil. We've acquired some long life water floods. We've got some nice drilling opportunities. We'll show you in the Frobisher, which is the second ranked play in all of North America. If you can find it, well, we found it, and we're the leader in the country in this play. So there's the top drillers in all of Canada on the second best play in North America. Who's the number one driller? 76 wells you see at the bottom there we've drilled in the last 3 years. And we've averaged just under 200 barrels a day of oil over the last 3 years. That's 3 years of public data. It's all public. We've gone from 0 to 8,250 barrels a day with a 290 locations, about 200 are Frobisher, 8-year inventory. And check out the well economics on the next page here. You're looking at a 332% risk rate of return, a payout in 0.5 years, 0.53 years. So half a year, you get your money back, 2 times payout, 1.5 years. That's what gets you second place on that Peters chart. You get your money back quickly, 100%, and 100% profit in 1.5 years. It's an amazing asset. This is just one of the Frobisher pools we have in Saskatchewan. It's a monster. Found a big discovery there years ago. And we just expanded the play to the southwest and to the northeast, had farm-ins, acquisitions. It's turned out to be, we're drilling the best wells in Saskatchewan. We beat out Whitecap on a big crown sale and a couple farm-ins, so we're probably 70% of the pool. Whitecap's the other 30. And one of the two of us generally drill the best wells in the province here every month. So we've taken it from about 1,000 barrels to 4,000 barrels today, light oil, high net back, and some of the wells we've had. If you look at the log at the top, in the old days, we would have drilled a Frobisher well into there's now 6 horizons to drill in. And now we're able to go in and drill 3 multilats into 3 of the horizons and not leave pay behind. And that's what's leading to these outrageous rates like 600 barrels a day, 400, 230, 348. These are way better than the type curve of that you see on the page here of 185 barrels. I'll leave you with this and then open up for questions. I didn't start working at Surge, and Jared didn't, to be second place to anybody. 2020 was horrific, downturn. But when you look now, we're the second top performer in Canada. We're the number 1 performer in Canada in 2022. Good performer in 23, 24. But now you see the market today with our amazing quarter. Our Q1 is going to be better. We have 10 of the top analysts in Canada. All 10 have Surge as a top pick or their firm's actual top pick. And we have some of the best upside to our share price with target prices over $10 and we're trading at $5. And I'm okay with that. I love that. Investors, I'll tell you how good we are when we're 10, but this is where you make money when the market is mispriced. The company, so I'll just leave you with this. We have 2 of the best, over 90% of our companies in 2 of the best 4 plays in North America. We have super low debt, 0.8 times cash flow, not 1.8, 0.8. We have a $250 million undrawn bank line. We have a high net back. We have cash flow that's around $300 million a year. If you take our fourth quarter, which is at around 70 WTI, and a really, $100 million of that is free cash flow. Well, our dividend's 50, so we could double the dividend. Instead, we said, no, let's buy our shares back because we're trading low at PDP values. And that's why you see shareholders going, wow, what a great quarter. But in Q1, the asset quality is shining through. We're averaging over 1,000 barrels a day above the budget that we thought we would be at. We thought we'd be 22,500. We're over 23,500 today, this last week, which is way above. And we have about 8 wells more to bring on in the first quarter here. So we're running way ahead of what we even budgeted a few months ago for our board. And we blew all 10 of these analyst numbers out of the water last night when we announced Q4, but Q1 is going to be even better. So that's our story. We'd love to open it up for any questions people have.
Okay. With that excess cash flow that you're getting from the well outperformance, what do you do with it? Do you use it as do you increase your buyback?
Yeah, so excess cash flow, we're saying our dividend's great, but 9% is a good enough yield. So we're going to take and we got our debt so low with a $250 million undrawn line. We're saying, let's take the excess free cash and buy back. We think we can buy back close to 3 to 4% of our company's shares over the year at 70 oil. So we're doing that. And we're ready when the market prices our stock closer to our total proved net asset value, which is $9.50 from Sproule. That's when we might add a growth wedge and say, right now we're growing because we're buying the shares back is way better use of our capital on a capital allocation basis than drilling. So it's kind of thrilling because we save our locations, we buy the shares back, we own more of the company, and the dividend becomes even more sacrosanct. And if we buy shares back, we don't have to pay the dividend on the shares that we retire to Treasury. We're quite comfortable with a 12-year inventory. Adding a growth wedge which would be about 30 million. So we could take that 30 million at a 5% growth wedge, but we're quite comfortable in this market to just buy our shares back.
Okay, two people asking about your shares outstanding, that they're basically the same as year over year or slightly higher. Can you just explain why that is?
Yeah, sure. So I think what they're referencing is 23 to 24. So we did start our buyback, but it was later in 2024, started in the summer. We have some normal course share comp that goes out. So that kind of counterbalanced the buybacks those last couple of months of 2024. Moving forward, as Paul alluded to, with the buybacks and the cash we're putting out here, we anticipate, dropping the share count in that 3 to 4% range over the course of 2025.
Okay. And let's see here. Okay. I just want to make sure like you don't have much left that's non-core, but anything else that you have for sale right now?
Yeah, we have a small property, or less than 10% of the company, up at Greater Son. It's about 2,000 barrels of oil, light oil. We don't dislike it at all. We like it, but that's not core to us. So we had it in a package. We got some lowball offers. Then we got some better offers. We'll see if it sells, but we're really highly focused in those two top areas now. We're over 90% of our company in those two top plays.
This is a long question here. Okay. The most important factor for all E&Ps, including Surge, is the price of WTI, which is now mid-60s. As most do not expect to see WTI at these levels, what would Surge look like if Trump's tariffs would bring on a global recession and $50 WTI? And what's your operating plan, financial plan under this scenario?
We've done this at least in my 13 years at Surge, or 11 years, sorry, at Surge, 13 if you count being on the board, 4 times. And we managed very well through this, including oil going to $11 a barrel in 2020. We pull back capital. We can stay flat at a really low number. Right now, we're running over 1,000 barrels a day above budget. So we would pull back our drilling count, stop all discretionary land, seismic, waterflood capital. And I think we could get our capital expenditures down to maybe 150, 140 million and still stay flat if we chose to. Jared touched on it, though. We've taken that good question to heart. So the day before Trump came in, the price of oil was over $80 a barrel, and our budget was 70. So we locked in some amazing hedges, 7,000 barrels a day in Q1, 5,500, 6,000 in Q2, and we have great hedging, 4,000 barrels, all above 70, some 75 WTI above that, as well as some costless collars. So we're really well insulated for an entire year here with these hedges on the books, and we did a meaningful amount of these hedges. So a lot of our exposure is hedged, and maybe mention the diff hedges as well.
Yeah, as we touched on, I pulled that slide up here. We've got meaningful hedges against tariff noise, as I talked about earlier. So that would help insulate us through the balance of this year. And we're a very holistic firm when it comes to hedging. We obviously talked about WTI, the differentials. The currency's been a big help with the currency dropping. We've taken advantage of that, as you can see on here, putting on substantial FX collars that help us enjoy the lower dollar here through the end of 26 in some cases. Hedge what little gas exposure we have, even our power costs. So really try to take a lot of the variability out to the extent we can, so that we can protect those free cash flows in the dividend.
And did you put some hedges on the currency?
We did, yep. So it's those foreign exchange rates there. You can see we ladder into them over time, put on collars so that we can enjoy drops in the Canadian dollar, but that if it does strengthen with government change or other things, that we can cap out and enjoy a low rate if it does run.
So 69 cents by 71 is roughly the range of our collars and for the Canadian dollar.
Sorry, I had the question screen up in front of me. Okay. What are the ways that you could reduce your total cost per barrel to ensure free cash flow at low oil price years? I mean, I think you've kind of gone to all your teams and said, where can you cut back? And there's probably always something more you can do, but
naturally we've seen the op costs drop there, as we said in the press release, nearly 10% from the start of last year. End of this year, take them down about $2.70 a barrel. The nice thing about focusing our operations on Hope Valley for et cetera is the op costs there are single digits. So the more we're drilling in Hope Valley, we can help to naturally decrease op costs over time by focusing our asset base in plays like Hope Valley.
And we've also, have you seen service costs come down yet?
No, I'd say they're pretty much flat this year to last year, and they're pretty reasonable. We saw a real jack up in them in 2022 when Russia invaded. Oil went to 100. Yeah. But right now, I think they're pretty reasonable, and we have no problem getting services at reasonable prices.
Yeah, I think they might come from down even more, possibly, if we see prices kind of stay around these levels. Is that fair?
Yeah, it could happen, and we'll be out grinding on service cost providers as well. So right now, I think our break even on capital and dividend is below $65 for an entire year. It's about $63 or $4 WTI for an entire year for capital plus the dividend. So we've really brought that down over the last few years. And the op cost question was good. By selling the non-core assets that had op costs at $30, $40 a barrel and focusing into Sparky, Southeast Sask, as Jared said, we're, some of our pools now, like Hope Valley and the Sparky and Provost, they're, $10 a barrel, not 30, 40. So we've seen, you do the math, that's over $20 million of free cash flow we created in 2024 by lowering the OPEX $2.50 on 23,000 barrels a day. You can do the math. And that funds about 40% of the dividend.
Yeah. Yeah. No, it's and they were, like you say, non-core. They're certainly prudent moves. Would you look at, what is the M&A market like right now? Is there anything of interest?
Yeah, there's a few assets that have come out just recently. The Vermilion package, they bought Westbrick for $1.1 billion. They're selling their Southeast Saskatchewan assets in a package, about 10,000 barrels.
So that's on the market now? Okay.
What's that?
That's on the market now? Yeah, okay.
Yeah, it came out through National Bank. There's one asset we really like. We have a water flood down at Onger. Beautiful long life water flood. They have the next one beside us. That one is about 1,500, 1,700 barrels. We would love to buy that. They have Weyburn unit, Midale unit. So they have nice chunks that could work for Surge. We're in there looking at it. So there's not that much on the street, but there's a few things that have started to come out here recently.
Prices, have we seen much trade at certain, I haven't seen much publicly done, a few things here and there, but privately, what are the multiples typically been?
We're seeing deals that are done for scabbier assets, 1.5 to 2 times cash flow. For good assets, 3 times. If a Weyburn unit sold, which is the penultimate water flood or CO2 flood in Saskatchewan, that could go for 4, 5, 6 times cash flow. But I'd say between 2 and 3 times cash flow, 3 being good assets, 2 or a little less being scabbier or gassier assets. So that would be the range, I'd say, of multiples.
Okay, great. Thank you. And obviously you do have some dry powder. So if you could get your hands on some of those Vermilion assets, it might be interesting, certainly additive for you.
Yeah. We're definitely looking.
Okay. Are there other companies? Okay, you have no real competition in the Sparky, right?
The Sparky's heated up, but the competition we have is probably a bit more to the north in the heavy oil window. In the light and medium gravity window, we're the big dog. We're like the spur of the Sparky, where spur is the big dog on the Clearwater play. Go one more slide over. So this week, our current production is over 13,000 already in the Sparky this year, and we have another, 6 wells to bring on before the end of the quarter in the Sparky. So it's exceeding our expectations. We are the big dog on the play. We've gone from 1,000 barrels a day in 2011 to over 13,000 barrels today. I did not know the play would work out this well, and it's about 22 API, 23. It's not heavy. It's medium gravity. Crude, and we've got about almost 500 drilling locations there, and we drill at a pace of about 35 this year, 34, I think, net wells this year. So huge inventory, beautiful water flood, and then the Hope Valley has just shown that we can grow this area, which it's so exciting because it's probably the second rank. It is the second ranked play in all of North America.
Okay. But you got in there for a steal and not at Clearwater prices.
Yeah, we started the Hope Valley play off a vertical well 4.5 years ago and assembled 32 sections of land, shot the 3Ds. There's Jared who walked you through that. We've got the big 3Ds, and we're out negotiating with a big company to try and fill in some of those gray lands. But we've got about 2/3 of it locked up, maybe a little less, a little more, but we would love to get. This is the same that happened to me at Crescent Point on the Bakken play. Over time, you just keep working the land base and adding sections.
I don't know how to ask this question, so I'm just gonna move along. Okay, the market does not seem to appreciate Surge's dividend, and the stock continues to decline. Would switching your capital allocation to a stock buyback instead of continuing the dividend and drilling, what investment can you make? Can you make 100% on each dollar instantly with the current share price, 50% of total approved value of $9.33?
Yeah, so I actually love where our stock is because the market is recognizing it. Today we're up 4.5% when I last looked. Almost every other company is down. We beat all 10 analysts' expectations of production and cash flow for the quarter. Our Q1 even looks better. I'll tell you how good we are when we're at $10, but at $5, it's a steal. And you get 9% dividend with the third lowest payout ratio in Canada in the peer group. I just love where we're trading at because I want people to make money. And we're going to be the top performer this year on sheer results. And that's what I love. But I would say the market is recognizing Surge's success. It's that we have for 9 years, a government that has actually tried to hurt the industry and not foster it. And it's a corrupt, inept government that has run up the debt massively, run up the M1, M2 money supply massively, and is actually trying to transfer wealth from the west to the east as their internal plan. And, in that's made Surge and other good companies in Canada somewhat uninvestable from U.S. shareholders. Smart people like on this call are going, hey, if we change to an honest, hardworking, good government that wants to actually foster the oil industry, Canada is now the 4th largest producer in the world. Surge is an industry leader on one of the top plays in Canada, in North America even. I believe we are going to be recognized. And this morning's recognition of our quarter kind of highlights that. So in other words, smart investors are going to be buying Surge right now and know that we're going to, in 2022, we traded as high as $13.50 a share on the Russian invasion. So there's your prize if you get into the right company. I guess I got to run to another meeting, but I would say this, Jess. Can you go to that last slide? I might leave Jared to answer any other questions if you have them. But the analyst slide that we have here, I would just say is pretty much my bottom line for current shareholders. I don't want to run an oil company. I've done that. I want to run the number one intermediate dividend oil company in all of Canada, and we are. And I'm not saying Headwater's not good or Tamarack, but right now we're trading at 3 times EV to DACF, and those guys are at 4 and Headwater's at 5. So a simple move up for Surge trading to 4.5 times EV to DACF, which means kind of cash flow per share. We crushed all the analysts. They were at 71 cents. We came in at 75 cents of cash flow per share. That's $3. You go to 4 times, that's $12. Or go to, I think we easily are going to $9 in a normal market over the course of this year. Well, that's 80% gain plus your dividend on top, plus the share buybacks. So I love the feel of our stock, and we want to go deliver for the people on this call and our shareholder base. What's fun for me is there's 10 of the top analysts in the country. We beat all 10 of their expectations, and we are the top performer today in the whole sector coming out with our quarter. So I'm going to let you, if you have other questions, Jess, I just got to run to another meeting. We're kind of stacked up today.
I apologize. Something happened to my internet and I dropped off there for a second. So I can get back to you. Most of these questions.
No, Jared's here and can answer any last questions you might have.
Okay, sure.
Okay, guys. Great. Thanks, Jess. Appreciate it.
Okay, thank you. Appreciate it. Okay, Jared, you're on the hot seat now.
Perfect.
Right.
If there's any last questions, happy to answer them.
Your dividend, we've already talked to, it's about safe to about 63, 64.
Yeah, fully funded there. And at that point, as we talked about, there's other capital levers we can pull in terms of reducing discretionary capital to reduce that further.
How much you've got? Probably about 10, 15 million bucks you could play around with?
Pretty easily to that point. And then after that, we can make further decisions from there. Grind service providers, look for cost savings as people will be pulling rigs, and costs should naturally come down throughout the industry. So those are the sorts of things we'd address if and when we saw those sorts of price environments.
Okay. And this person says, great work. Would you consider selling?
I think the great thing about Surge is, we've got a very business-oriented management team with some large shareholdings as percentages of personal net wealth and shareholder lists. So everyone here is very aligned with our shareholders. So as Paul likes to say, I think we're buyers or sellers every day. If there's good assets to acquire, as Paul talked about, we'll look at them. If someone sees the value in Surge and pays the appropriate price for it, of course, we'd be willing to look at that as well.
Related to the earlier question, can you provide further explanation as to why Surge continues to record accounting losses annually, yet your wells of economics that are returning back the cost of drilling and 100% profit in 2 years? Those are all the plays you sold, basically.
Yeah, that's right. Exactly. So it's losses on disposition, impairment charges on the historical carrying cost of those non-core assets that we sold. So don't foresee anything meaningful from that perspective moving forward now that we've sold 2 of the 3 non-core assets. So I think we'll be in a good position at these price levels to return to an accounting net income level in 2025.
Can you explain how tariffs impact the Canadian oil and gas price, your hedges and bottom line? Is there a risk that hedge value could be challenged if someone claims that tariffs were not considered part of the hedge investment and need to be adjusted? I think when you've entered a contract, there's no way they could step back on it. Is that correct?
We've reviewed it with our lawyers. I think we're pretty confident in our position there on those. So I don't see that right now as a risk to Surge. Even if that were to happen, we've only seen the differentials widen by a couple dollars, which isn't massively impactful when you have the sorts of margins we have. Of course, we'd like them to be tighter and get away from all this tariff discussion. But between the hedge book and just the limited widening in differentials, a lot of the hit is mitigated from the tariffs.
Okay. And then on the bank line, which you have completely undrawn, I may reiterate, would you, for example, instead of looking at buying more drilling properties, why not buy back your stock at 3 times?
Yeah, no, that's a good question, and that's holistically how we look at M&A, right? Surge is an M&A target for us, right? So to the extent we're spending cash acquiring assets, we always look at the value in whatever we're looking at as opposed to just simply buying more of our own company. So we always do that sort of analysis when we look at any sort of M&A. Is Surge the best thing to buy using our cash, aka buying our stock back, or is there something that can be more additive to our shareholders even in above and beyond buying our shares back?
Yeah, no, exactly. And I didn't, you mentioned working with two larger companies on a 250 million barrel pool.
Yeah, I believe what Paul was referencing was the fact that there's a large Canadian oil company that owns some of the lands in gray here on the Hope Valley.
Oh, I know what this person's talking about now. Yes. Okay. Okay.
All right. Yeah. So continue to try and add lands in our core areas all the time for sure.
Yeah. You're trying to, buy them from them, I'm assuming.
Yes.
And then you're not at tertiary floods in any of your fields yet, are you?
No, we have no polymer floods. That's a great thing about that low recovery factor we showed earlier is we've got a long way until the expense, polymer, tertiary recovery, CO2, whichever you look at, it's quite expensive to put in place. It's great, but we're a long ways away from needing that. We've got a lot of upside through water flood first before we need to start considering things like polymer.
And one question, one person asking, would you just get debt free? But that's an inefficient use of capital, so I can answer that one for you without even being a CFO.
Yeah, no, that's right. We always want to have a modest, reasonable amount of long-term unsecured debt, which we now have, to accelerate our shareholder returns, right? So don't see a situation where Surge goes debt-free, continuing to lowering the debt. Yep, we will do that within a reasonable range, but we'll always have a modest amount of leverage to enhance our shareholder returns.
Okay, so back to the buyback, using your line to buy back. Are there any restrictions?
Our documents are all filed there on CDAR, so there are some higher level distribution covenants once you get over, say, $100 million, but those are all things we can negotiate if and when we need access to that. So we have lots of runway under our current credit agreements, for example, to use the bank line for buybacks.
Okay. And I think I've answered most of the questions. And let's see if I had any others. I mean, the stock looks great here. I mean, at 15% return you're offering without, that's without any sort of capital gains from the stock, and trading at a pretty decent multiple, lower than the peer group. And what do you think is the biggest risk, and what do you think is holding you back the most, just for market cap size?
Yeah, I guess I'd maybe challenge that comment about versus the peer group. When we isolate to the sub $2 billion oil weighted guys, we have a better than average multiple. I think Paul alluded to it and he's right. It's a small, to your point, market cap, and being in Canada right now, Canada's not in vogue. And so we've seen some sectoral rotation. So those that are investing in Canada in oil tend to be, hiding out, as you will, in Cenovus and some of the bigger guys. So our hope is as we continue to outperform here and we start to see some stability or change in government, that folks will be more comfortable coming back into Canada, and that could really, really help lift us and some of our peers.
Yeah, I mean, I haven't. And I was talking with some American investors yesterday. They didn't seem like too put off about putting money into Canada, particularly. But
yeah, we're starting to see some green shoots. People are reading the tea leaves on government change and getting in front of it. So it's good to see smart guys looking forward.
As long as we don't end up with the liar, we should be okay. Yeah. And your decommissioning program, do you want to talk about that?
Yeah, I can kind of finish on that one there. Yeah, so decommissioning, Surge takes our environmental responsibilities seriously. We spend about 50% more than we're mandated by the various government agencies in Alberta and Saskatchewan. So inclusive in our cash flow, I'll just go to that slide. Inclusive in our cash flow is about a $16 million budget for abandonment spending. So that's really the difference between the adjusted funds flow and the cash flow here is pretty much our ARO spendings, our abandonment spending. So we're spending more than we need to, and that helps us reduce our operating costs. So you don't have to pay property taxes on inactive wells, for example. So it pays dividends, if you will, to our shareholders through reducing our cash costs as we take care of those liabilities. So we've got a good program to kind of do that annually. It's part of our cash flows.
Okay. Well, I don't think there's any more questions, so maybe we'll just end it there because we keep breaking up. But we'll get back together another time.
Fabulous. Well, thanks everyone for your time. We appreciate it. Thanks, Jess, for organizing this, and we'll see you at the next update.
If anyone has any questions, let me just email me at jessica@adcap.ca, or if you need further information from the company, happy to arrange a meeting. Thank you. Thanks, Jared. Okay.
Take care, everyone.